Cool. So we're going to get started. And I'm Charlie O'Donnell, and I'm representing Next NYC. Next NYC is an events and community platform here in New York for founders, for investors. And this is an exciting conversation for me because Ali and I met first, God, quite a while ago. When did you graduate school?
It's probably me just like chasing you down over cold emails. And you just were either weak or kind and just caved in and met with me.
And yeah, but that's your thing. And you got out there and network your way in the community. It's kind of hard not to pay attention to you. And I've got my co-host here. And why don't you introduce yourself?
Yeah, happy
Yeah.
to. Hey everyone, my name's Hallie. I am the head of growth at Sidecar. We are a fund and SPV administration platform focused on enabling emerging managers. And super excited to dive into the conversation today.
Cool. Ali, why don't you just give us the just quick, just 2 minutes on just, you know, Crossbeam, CoVenture, all of the
Yeah.
things that you run, size and scope, like where are you now? And then we'll sort of take you back to when you got started.
Yeah, perfect. So today we have a holding company, and underneath the holding company are two investment managers. One's a credit business called CoVenture, and what we do there is we find fintech companies or companies broadly that have identified a new asset class or a use of capital that's not general payroll or general corporate expenses, but they might be doing acquisitions of cash flowing assets. They might be funding loans if it's a lending company or a financing business, and we provide asset-backed credit to those companies. And I say asset-backed credit, that's unique from venture debt. So again, it's not corporate lending. What we're doing is we're providing capital for a specific use case, which is to fund either a soft asset like a receivable or a small business, or a hard asset like a car or a home or something that you can feel, push, pull, or touch. If you can look at it, see it, push it, fraud it, we've probably funded it. And so that business is about 2 billion of AUM. We launched another credit business called Hybrid Capital Solutions. There, what we do is we provide anywhere between 25 million and 150 million at a time to companies that are broadly founder owned, although not always. They usually can't agree with the market on price. And so we provide them a structured solution to kind of bridge the price gap between what investors would expect and what founders would expect. The other version, what that fund will do is we'll do things where it's sort of a quasi-corporate, quasi-asset-backed deal, where there's kind of two components. So anything that doesn't fit in a normal bucket, it's either too complicated, it's weird, it's funky, but if the company needs 50, 75, $100 million in 10 days or 6 months for something that people don't understand, we're usually the solutions-oriented fund that'll do that. So those are the two credit businesses we run: Hybrid Capital Solutions and asset-backed credit. And then, my first love was always venture capital, and that's why I would run around bothering people like Charlie. And so there we manage a fund called Crossbeam, and that's our affiliate business under the same holding company. And we write, $500,000 to $3 million investments into seed companies, or $1 to $5 million co-investments into Series A, B, and C companies. And we're a generalist fund. We obviously have our themes like everybody does. We've historically had the most success investing in what we call platform economies. So those are businesses that exist within the YouTube ecosystem, Salesforce ecosystem, Shopify ecosystem, any of these big platforms. We've invested actively in emerging forms of media. We've done a lot of fintech investing, but we do basic SaaS investing. And of course, everybody, is investing in AI now. And so we are basic VCs who also do. But yeah, that's us in a nutshell.
Cool. And you're roughly at about 2.5 under management, 2.5 billion.
Yeah, we're about 2.5 billion under management. We have about 40 employees. The firm is based at 50th and Madison. So we're in New York. Yeah, we have a handful of people in LA and San Francisco and Miami and Denver and the places you'd expect, but we're mostly in New York.
And just for context, the first amount of money that you ever tried to raise for a deal was how much and when was that?
So my senior year in school, we had a fund that was supposed to be used where we'd pay developers to build software for equity. And that was $391,500. And the 1,500 odd lot, although I'd say 390 is also an odd lot. 500 was from a friend of mine in school, and 1,000 was from an LP who was supposed to be $5,000 and only funded 1,000 of it. So it was pretty Pretty exciting. Very institutional.
So that's pretty good compound growth from that to $2.5 billion over that period of time.
Yeah, yeah. And I was thinking about what to talk about. I mean, I'm happy to talk about the super non-linear version of kind of how we went from one place to the other. I think ultimately everybody's fundraising story ends up being a little bit different. So my lessons are all, broadly from my own experiences, and I'm happy to talk about the versions of it I've seen. But yeah, our there was like no silver bullet moment in our process. It was a desperate and grueling however many years.
Gotcha.
So maybe that's a good jumping off point. There's no silver bullet, but you've had this tremendous amount of success, and you wrote this great piece on networking, how I built my network before I knew anyone, that kind of goes through in quite a bit of detail some of the tactics that you used to start your fundraising journey, as Charlie called out, starting in college. So maybe instead of trying to find a silver bullet, can you talk about a couple of the things when you see people trying to break into VC or any type of private market investing? What do you think people are getting wrong when it comes to networking?
I mean, I think the quickest thing that they get wrong is they're like, I want to start a VC fund, so let me go raise money now. And I think the problem is, when you're raising a first-time fund, you can either raise because you have an epic track record, and most people who do new funds don't necessarily have an epic track record. And if they do, it's sometimes hard to attribute it to themselves because they might have been at a larger firm where, if you're at some, huge firm that has tons of success, was it you? Was it the brand? How real is that? You also, if you have that good of a track record, you probably have an LP who's part of the firm that you're already at, who's kind of like convinced you to go start a new fund. So it's almost like irrelevant for this conversation of somebody who has like a Midas list type track record. And by the way, like having a good track record isn't enough. Like I know a lot of friends who have worked at some of these large firms, and they show me this like Excel sheet, and they're like MOIC is like 5 or 6 times, and their DPI is probably over 1, and they're like, isn't this good? And that's not what I mean by like a really good track record. I'm talking like epic amounts of like you're like a renowned individual. So that would be like one way to start a fund, and that's the easiest. Obviously, it's the easiest and the hardest. The second is you already know people who would want to give you capital. And I think people would be like totally shocked if they realize how many funds got started, not because some GP said, I want to go start a VC fund now, but because there was some like LP in the world who like has loved a person, and they like pitched them the idea of like, hey, if I seeded you, would you go start a business? And I've seen that happen. Actually, I've even done it. I have an incredibly close friend, and he's never missed a point on a standardized test. Perfect SAT, perfect LSAT, perfect GMAT. I went to school with him. I think he's a complete genius. He's also the hardest working individual I know. And, he was in between stuff, and we had a pool of capital at the time. And I said, hey, I'd give you $100 million to go launch a fund. And the way that happened is I just known him for like 10 or 15 years. And if he went out and told a story of like how he got started, he'd be like, I don't know, somebody gave me $100 million to go start a fund. And his whole fundraise was he started raising money his freshman year in college when he and I were going to school together. And he just was the smartest kid at Cornell his year. And so, sometimes it's somebody
He just didn't know he was raising a fund.
Exactly. I mean, I joke that like people started raising money, whether it's for a startup or for a fund, their freshman year in high school. Like there's a girl or a woman now named Christina Sue. I don't even know where she is now, but she was the smartest kid in my high school. And I used to literally use her pencil to take tests, and I'd call it the elder pencil, like the elder wand from Harry Potter, because she was just like a genius. And like every time she raised her hand in class, the teacher would just like erase the board and ask Christina what she had gotten wrong. Like she wasn't asking a question. If Christina ever had an idea for a startup, we have like a blank check. Christina, if you're out there, we have a blank check for you. So that's one of the ways, is like you just are a person who in your life, you've built a reputation for yourself where you're one of a kind, and there are people who are in positions where they manage capital and they pick you. And so that's also just knowing people who would give you capital. And then the third is you have a good story. And this is like my least favorite version of it. And I think that I have a bias against sector-focused funds or regional-focused funds. I think a lot of funds get set up for the purpose of raising money, not for the purpose of investing. And if you were an LP and you believed in like a manager as little as possible, what you would do is you want to give the tightest restrictions to that GP so that like they wouldn't screw it up too much. And if you believed in them as much as possible, you would give them like no restrictions. And then often, what an LP wants to do is they want to like figure out how to get something through their IC. And so they need like a narrative of like, why is this the fund that they're going to invest in? And like they need a story. And so I think a lot of people come with these like cockamamie ideas or stories or narratives of like why they're going to be like strategic or sector oriented or thesis oriented. And those are like broadly the three main ways. I definitely think the best way is to use years and years of your career to build relationships with people who will kind of back you for anything. And the reason that's the right thing to do is because the more flexibility you have on how you can invest your capital, you're more likely to be successful because you're more likely to be opportunistic. And it turns out there's a reason like the best VC firms are broadly generalists. Like Benchmark is a generalist firm, Sequoia is a generalist firm, First Round's a generalist firm, USV, even though they have theses and themes, is a generalist firm. And I think it's because venture capital is an inherently opportunistic asset class. And also, if you thought of what the leading indicator of a good firm was, it's probably the best people. Anyone on this call, if you could go work at a sector-oriented fund or a generalist fund, I bet you almost all of you would pick a generalist fund. And so it's just easier to recruit.
And to that point as well, I do think that ultimately, because you're not selling an asset, you're selling a blind pool, right? You're really selling trust as a big part of it. So I could tell you a story, but if I don't already have trust in you, and we'll talk a little bit about borrowing trust from others and introductions and all of this sort of stuff, starting from zero trust for a blind pool is a really tough position, no matter what the story is.
I also even think it's closer to like starting from like 80% trust. And Charlie, I'm sure you'll resonate with this. Like when you're looking at a startup company, there's like 15 to 20 things you need to believe about the company for it to work. Like the product needs to be good, the market needs to be big, the founder needs to be like the go-to-market. And like the worst passes ever is when you agree with all 15 things. The problem is you're like 90% sure about all 15 of them. So like 0.9 to the 15th power is such a low number that you could never invest. And I feel like a lot of LPs, like if I said, oh my gosh, like I know Charlie and he's epic deal flow. And like, I promise if you call him, like he'll vouch for me. There's like 90% sure that's true. Like that'd be an awkward lie and like a lie that they could pretty quickly suss out. But like for them to get to 99%, like they need to call Charlie and they need to call like Bill at First Round and they need to call like Brian, Feinstein at Bet. Like they need to like call a lot of people. And it's like anything in life, the last 9% takes 80% of the diligence time.
Well, and I've said this to a couple of founders too, who were trying to figure out why they were getting all over the board feedback on their companies. And I used the slightly different scale. I said, you know what? You're like a 7. There's nothing inherently wrong with anything you've just said. I'm just not a 9, 10, or 11 on any of it. And so I'm literally making up a reason why something is wrong with this, but there is just nothing wrong. It's just not fantastic. And nothing stands out about this thing.
Yeah. And there's like a lot of really good people. It's and I think, it's also that I'm sure you've had this trouble with portfolio companies where we'll have a company and they're doing great, but there's another company in their space that's doing just as well. And they raise this like $30 million Series A at some YOLO valuation from some epic firm. And they're like, well, I want to go raise a $30 million Series A. And it's like, you can't learn from that exceptional data point. Like, we wish you got lucky. You did not. So you have to now still go through the normal $5 to $10 million Series A and keep doing what you can control. And if you get lucky, how amazing would that be? But you can't use one person's luck. Like that friend of mine from college, he got a little lucky that like his close friend now manages capital where I could have given him, seed capital. But like, I'm probably the only one of his friend group who could have done that. And if we didn't happen to have the same classes and stuff, he would have had to go the normal route.
So going back to pulling on this thread of kind of like, how can you get started building trust from nothing? One of the themes that you talked about a bit in this article is this idea of leveraging the credibility of other people. So can you talk a little bit about how you convinced those other people to trust you early on and kind of built upon that foundation?
Yeah.
And the article, by the way, is you wrote this piece about how I got started from not knowing anybody. Literally, actually Googled how did Ali Hamed get started, and this is what came up. And it's the post is how I built my network before I knew anyone.
Yeah. The way it happened, so I went to Cornell, and I knew that I wanted to do a startup freshman year. I was just like obsessed with the concept. Like, I got one of those stupid head first books on how to code. And I was just like, and I was like that loser in my dorm who like never went outside. Actually, my freshman year roommate, Ben Swinford, don't mind calling him out, would literally like bring friends into our dorm so they could see how many flashcards I had written for myself. It was like his party trick to impress people based on like how much of a loser his roommate was. And, I ended up having like, really good grades, and I had impressed a handful of my professors, and I was like the kid who did everything on campus. Like I was on the baseball team, but I like got involved in the Cornell Daily Sun, and I was doing research, and like, I would like to think that I, punched above my weight class. And one of my professors encouraged me to go speak on a panel about internet governance. And they wanted like some student entrepreneur, like a token student who was trying to do a startup, to like fill out this panel that was full of like all these epic people who actually had real companies. And, it was like a pretty basic topic. It was like, how do you roll out like internet policies in the continent of Africa? I ended up going to go speak at the UN in Kenya, which was a really cool experience for a 19-year-old. And it was like really basic stuff of like, well, if a server's in one country, what data privacy laws you have to abide by, stuff that like anybody who had thought about it for 14 seconds could like give an opinion on. You didn't even have to be right. You just had to have an opinion. And I used that to say, and to like have some level of credibility. And I met some people who came up after the panel, and they would say, what do I do? And my startup had already failed at that point. So I said, I'm a consultant, which basically means I don't do anything. And I said, well, what do you do? And no matter what they would say, I'd find a way that I could help. And so I would build them a web application or an iOS application, or eventually I hired a small team of developers using the proceeds for the first couple of projects. And I was basically just a dev shop. And I just called, like, I gave dev shops a glow up and called it a consulting firm. And I saved up a little bit of money where I could make a couple of small, tiny investments. The problem is like I had no deal flow. And so what I did is I worked with this guy, Brian Harbit, who now sits in that office. And we would do these research decks, and you could still find them on SlideShare. I mean, we thought they were impressive at the time, but not that great. But we would do them on certain industries. We would do it on the staffing industry, hospitality industry, marketplace infrastructure, the type of stuff that if you were a 20-year-old in college and you wanted to guarantee that you wouldn't have friends, this is the project you would want to work on. And so what we would do is we'd basically cold email Cornell alumni who were working in corp dev offices in some of these industries, and would say, hey, I'm a Cornell student. I'd love to talk to you about like what I got wrong. And then we'd start putting logos of companies in portfolios of VC firms that we wanted to meet. And then I would just cold email them. And so like, I remember Ian Siglo at Greycroft was like one of my first cold emails, or like, those type, Charlie was probably one of my first cold emails. And, you'd guess at the email address, like first initial, last name, first name dot last name. And my email was something like, hey, like, I'd love to talk to you for 15 minutes about this research report we did and what we got wrong. And we really tried hard to avoid the question of, how do I get a job in venture capital? Because, and I'm sure Charlie's gotten 90,000 of these, like, it's not that he doesn't want to help you get a job. It's just like, it's not a 10-minute call. It is a long process of how to get a job in venture capital. Nobody ever follows the advice. Like, there's also no way Charlie can get on like a 15-minute call with somebody and like vouch for them after it and like help them network. He'll lose his credibility. But it was really simple if I said, Charlie, like, I know you're in Canary and I'm doing like a project on security software. Like, can you give me like a 4-minute phone call of like what you think I got right or wrong? Because Charlie and any venture capitalist, really, they're in that business because they actually do enjoy helping people. It just sucks to be asked to help on something you can't help. And like, but people could. I made myself easy to help. And then what I would do is I'd surprise them and I'd say, oh, did you know that I've actually talked to the corp dev offices of 2 or 3 companies that may want to buy your portfolio company? And like, that was like a surprising thing for somebody in venture capital to hear from like a 20-year-old sophomore in college. And I'd connect them to a few groups, and maybe conversations happened or didn't, but I definitely stood out at that point. And then what I would do is I'd start introducing VCs who didn't know each other, but were investing in the same industry. And it's like the classic, like, if you're not invited to a party, like, start your own. I'd like get the 3 of us or 4 of us together for drinks. And nobody wanted me to be there, but I was like the necessary attendee in order for them to meet. And, I'd bring my stupid little fake ID and I'd go to the bouncer and I'd say, this is a fake ID, but I'll only order like soda or coffee. I really need to get in this bar and join for drinks. And I would meet one VC after another. And I ended up helping an individual named David Hirsch at a firm called Compound invest in a handful of his portfolio companies. And those companies ended up doing very well. And I found this business called Produce Pay at about the same time. And Produce Pay was basically financing these perishable produce farmers. And there's this unique trick about how the credit worked, which is if you became a title holder to produce, you become super senior lien on the distributor holding the produce. It's a long story. It doesn't matter. It's a good credit. It was a good deal. And this is like the second really important part, which Charlie mentioned, which is building trust. I didn't try to like go from knowing people to getting them to invest in a blind pool fund. Instead, what I did is I convinced them to invest in a single name SPV, and not even of a startup company. I convinced them to invest in a loan product where like there was interest payments and every month you would get interest, and I could explain the exact deal where they didn't have to believe. Like, if you give money to an individual to invest out of a blind pool, you have to believe they can find deals, they can do diligence on those deals, they can help companies, they can hire a team, and they can raise capital other than just you. If you raise money for a single name SPV, they don't have to believe you can find deals. You already found it. And they don't believe you can diligence deals because the diligence is already there. They can judge the work done. They do have to kind of believe that you have to like not be like a total clown about how you manage the portfolio once you've made the investment. You don't have to hire people. You've already done the deal. And then, you know, the round's going to close or not. So you only have to get them to like believe one thing, which is you're not a clown. And that was basically the first thing I started raising money for. And I went to David, and I went to a lot of other venture capitalists that I had met, and I asked them if they had any LPs, and they were willing to make the introduction because I wasn't raising money for a venture capital fund. I was raising money for a loan that I was trying to make. So it wasn't competitive. And David introduced me to a guy named Mark Spilker, and Mark had been the president of Apollo. And, you know, before that he had run GSAM. And, you know, I think he thought the product was compelling and it was differentiated. And that was one thread of how I got to know people. But, you know, you mentioned like social credibility. I focused a lot on social density. Mark was one individual I'd met, but I also had met a bunch of Cornell alum who came back and spoke at classes. And I had put myself in a position where a lot of the professors would kind of recommend me as one of the students that alumni would meet. And I met a guy named Savneet Singh, who had been a successful fintech entrepreneur and had built a large company. And he started introducing me to a lot of people. And they had overlapping networks. And so I'd often meet the same person through 2 or 3 different ways. So they started to kind of get like this 3D picture of, okay, there's credibility here. Multiple people have given him money and they think it's a good experience. It's a product that has a short feedback loop, unlike venture, because interest payments get paid every month. So my credibility could grow a lot more quickly than in venture capital. And then I would start identifying like who are the people I knew, and I'd go to their LinkedIns. And LinkedIn's annoying in that you can't export somebody's network. You have to, but you can look at who they know 10 people at a time. And, you know, the advantage that you have as a young person is you have more time because you don't have portfolio companies and stuff yet. And, you know, I probably had no friends. So
Or in your case, the life.
Yeah, yeah, like when you're young, you're kind of indestructible. Like I probably worked 18 to 20 hours a day. And that's not an exaggeration. And I would just sit there and I'd go 10 names at a time. And I'd like look at every single person one of these people knew. And then I'd basically do an analysis for them. I'd break out, these are all the LPs, you know, these are the GPs, you know, these are the founders, you know. And then I would write them forwardable emails because I assumed that the average person only knows, you know, 20 to 30% of the people in their LinkedIn well enough. And I would never say, hey, Charlie, can you make an introduction to an investor? Because one, that's like an annoying ask for you because now
I gotta figure out who the right person is. And
you're asking for a favor. Like you may want a favor some other time from them. But if I said, you know, Charlie, I noticed that you know this person at, you know, Nick at the Trinity Church Endowment or whatever, and the reason I want to meet them is X, Y, and Z, and I just write you an email that you can literally look at your phone and forward it, and it has Nick's name in it, so that Nick feels obligated to take it, and also you don't feel like a jerk for like volunteering his time. I've already asked for him specifically. You're doing me like a small favor, but the reduction in favor value is so low that you actually are making the calculation of like, not a lot of skin on my back. And now Ali owes me a slightly bigger favor because like I helped him meet Nick. And so like your VC calculation is actually a net positive one, which is it's almost no problem. And I'm just making Nick up because I was talking to him recently, but whomever, your calculation is I almost asked for nothing. I was just playing messenger here. Nick is so much more likely to respond to that, by the way, than if like it was a generalist thing, because then he can't claim that he never got it. Like he can't say no anonymously. He has to put his name next to his no. I don't want to meet this guy. And I would never try to like, and so I realized that the average person I knew had to introduce me to more than one person. And so my job was to take everybody I'd ever met to that initial kickstart of the research reports and make sure that on average, I would meet 2 or more people per person I already knew. And the way I'd do it is through these forwardable emails where I'd write Charlie like 10. I would hope that he would only get me to 2 or 3. And then that person became the next node. And the goal was not to get money from them. The goal was to tell them what I was working on, figure out what they needed, and then like work really hard to find a way to help them in some way. Help them meet another manager, help them meet another deal. And I would just constantly kind of build this top of funnel. And that's really how I got the flywheel started.
so I just want to comment on 2 things. One is your initial email to me, introduction, Cornell student entrepreneur, was July 17th, 2013.
Wait, actually?
Yeah. Yeah. Sorry, January 17th, 2013.
Okay. Yeah, it's junior year.
You knew exactly who you were writing to and why, got inspired by you by moving first round, starting your own firm. Would love to hear your story, which I didn't initially respond to, and I feel bad about.
No, that's
But
okay.
do you know the person who introduced us?
No, not off the top of my head.
Maddie Maxey.
Oh my gosh. Wow, that is a great blast from the
Who
past.
used to work at GA and now is doing stuff in like material science, who's an absolutely terrific person. And so she introduced us, we met. And then what
Oh,
really
wow.
strikes me is the email exchange I have with you after was I introduced you to the founder of GitLinks. Is it Ian? Yeah, Ian, the founder of GitLinks, not long after. And what is striking, so this is like a first round capital portfolio company. This is like a, serious founder that I just introduced this college kid to. And his email in response, because he responded to you and you thanked me for the introduction, was like, you totally get what we're doing. Like, thanks so much for the great conversation. Like, you really won him over in that discussion. So I was like, that was like, now I feel so much more comfortable introducing Ali around to other people because this big time, venture backed entrepreneur responded back. It was like, hey, dude, that was an awesome conversation. And it was like really in depth. And clearly you've done your work getting into it and you followed up. And that was sort of the beginning of a trail.
Yeah, it's the tryout. You never get put into the big leagues initially. There's a guy that works really closely with us now, named Michael Ovitz, and Michael's kind of been around the venture world for a long time. And this is sort of like, this is fast forward years and years. Getting to Michael took however many years of getting to him. But the relationship was the exact same. Like, he would introduce me to a couple companies that he was looking at, and we'd do a pitch call together where we'd sit there and we'd decide if we thought the company was interesting or not, and we'd debate it. And only after that, he introduced me to a handful of VCs that, like, if I ended up being crappy, it wasn't going to be the end of the world for him. But he wanted to like see if I could keep up with those people. And I would say for like 90 to 120 days, he would just keep putting me in escalating conversations to see how I would do. And then finally, I forgot which names he said publicly. He put me in like, in the room with this guy who runs like a $20 billion hedge fund, and was like, let's see what happens. And that is a normal, Michael's like the king at it, but that is a very normal cadence for people who are trying to figure out, where is this person supposed to slot in to my life.
Gotcha. So I'm curious. I don't know if you like had this long-term goal of building a fund, or you just like into the network building and knew that that was going to be sort of a rainy day fund of valuable contacts at some point. But what always sort of struck me, and this is really, if I'm going through the emails in the background, you then introduced me like sort of a year later to the founder of Fly Labs, which ultimately sold to Google. Didn't do that deal. Don't think it was a huge exit, but like good guy. You never stop. Like, you're always doing this, doing something that will lead to another connection. And I'm curious, like, two things. And this goes back to like the fundraising. Is there ever a point where, and a lot of people don't network because they feel like it feels transactional, right? And they don't like that word transactional, which is weird because we are ultimately trying to do transactions, and a transaction only happens when there's equal value on both sides and all of that sort of stuff. But transactional in networking feels like a dirty word to some people. And then the second part of that is, okay, so you're building all this sort of stuff. And at some point, and this is why we're here, you have to make asks. And you said your earlier point, ideally people make offers, but how do you know when the right time to draw on that social capital is? So, do you have that end ask in mind, or are you just doing that? And then like, when do you feel like it's a good time where you're enough in the credit side to pull the trigger?
Yeah, the only when I think I've earned it. So, like, I wouldn't ask for something that I haven't earned. And, so then I never feel like, have you ever been to a restaurant where, like, I don't know, like Lilia or Teresa, like one of like the really, really good ones, and you're talking to the waiter or waitress. Actually, we saw each other at Pasquale Jones. That's a good example. Like, you're talking to the waiter or waitress, and you can just tell they're like, you're gonna fucking love this dish. Like, it is such a cool experience, and that they love it And then what they're like, you should get the ribeye. Like whatever they upsell you. They're like, you're gonna thank me. Like I convinced you to over order, but you're lucky I did because now you're gonna try something that's amazing. I want to have that feeling when I make an ask where like I want to show them a product that sells itself and I've earned the right to make that ask. Like when I meet people in credit, this is going to sound horrible. I don't mean to sound narcissistic. Like I'm like, I can't wait till the punchline of what I'm going to tell you of why that like when you find out that in produce pay, you're getting paid like you're financing a Latin American farmer, but the credit risk you're taking is a US based distributor. And here's how. I'm like, that's my like line. Like, I just know that it's going to work. And I don't think that I'm making an ask at that point. I think the person might be lucky if they get to be in the deal. I really do. And if I don't, then I shouldn't be in business. And I think that's actually why a lot of people feel like they're making an ask is if they feel like they're like, hey, will you invest in my venture fund and you're doing me a favor for doing it, then probably don't ask them. But if you feel like, you've done all the right things and it's not just having a good venture fund, but it's a fund that's going to fit with what they need. And, you have the evidence of it and you know that 2 or 3 people around them are going to vouch for you. Like you've put together that perfect thing. That's when the ask is perfect. So part of it is earning the ask. Part of it is you have to like enjoy it. Like like when we reached out, I thought this was going to be in person. My first reaction, you saw, was like, oh my God, this is awesome. I get to catch up with Charlie. Like, it's not network. I fucking love hanging out with you. Like, you've been around for seen so many interesting companies, and I learned so much from you every time I talk to you. And like, I spend the next week thinking about the conversation. Like, I just really enjoy it.
These are hard earned.
I just enjoy the shit out of it. And I keep thinking, God, like college me would think it was so cool that I get to have coffee with Charlie. Like, man, I had to work so hard for it. Like, I don't know. It just, maybe you can even tell by how I'm talking about it, I just really love this business. And I don't think that you'd be willing to sit there and go through all the LinkedIn things and write all those portable emails and send the available times and get on the subway and go to all those meetings unless you actually couldn't wait to be in the conversation and get something out of it. I just think it's the best business in the world. And venture capital is so fun because you're constantly meeting with founders and other investors who, sure, there's tons of VCs who suck. And if you're in the business long enough, you just know which ones they are and you can avoid them, or at least you know the ones that you love. And hanging out with Jesse Beirudi at IA, what a freaking pleasure. Like he just has a cool idea and a cool way of thinking, and you give him a problem and he helps you solve it. I've never thought of that as work a day in my life. So I don't know. So part of it is the enjoyment, part of it is earning the ask. And then part of it is also having long enough feedback loops because you can make a bigger ask the longer you've known somebody. Because the longer you've known somebody, it's not like you fooled them into thinking that they're your friend. And now like you came through the back door and bam, here's the ask. The longer you've known someone, the more conviction they have in you. So the more of an ask they're willing to provide you because they have a higher conviction level. And it is more sincere. Like you've invested in the relationship. So I've never minded making the ask if I feel like I earned it, if I feel like I had been the social creditor in that I've helped them already, if I felt like it was sincere and I felt like I let the right amount of positive feedback loops go through.
So let's take a step back to, before earning the ask and earlier in the process of meeting some of these people, pre kind of building that relationship and credibility. So like if someone introduced you to a high net worth individual, what does the typical opening conversation look like? What are you leading with? What are you hoping to learn and like get to know about them to build that relationship?
I'm trying to build like-mindedness. So I'm usually just talking to them about investing. And I'm talking to them about, I have whatever the thing of the day is. I like totally don't mind talking about politics. I totally don't mind talking about things that are happening in the world. I don't mind talking about investing. Like I do mind small talk. Like small talk sucks. And like I'm impossible to offend. You could have the complete opposite view of me about something political, and like that's okay. I want to know why. Like I'm like half Jewish, half Muslim. It's like I have like the total like card that I can talk about anything happening in the Middle East right now because everybody thinks that I agree with them because I'm allegedly in the middle and they assume that they're right. So like it's like I love talking about that stuff because it doesn't mean that I agree with them or don't agree with them. We're just talking about stuff that matters, and it's like you're almost in an IC about the world. And at the end of it, if like the conversation was like hard and like we kept trying to figure out what to talk about next, then like I'm not going to make an ask. They're probably not a relationship that I'm ever going to build sincerely. And I hope they have a wonderful life. And if at the end of it, we feel like the time is up, but we could have kept going, then it's like, all right, like I think I actually could build a friendship with this person. And so, we do events once a month. Charlie, I know you do tons of these. You invite them and like you see how they mix with your group. And like the best case scenario is they come and they make a few friends. And now they're like kind of in the social circle. And then like, like Monday night, I got a reservation at a place for 5 people for dinner. And like, I'm really careful to make sure that all 5 of those people are going to like get along with each other. They're all from the same industry. There's no like agenda behind it. If 2 or 3 of them end up like doing business outside of it, they're probably going to come to the next thing. It's going to be helpful anyway. I'm incredibly particular about picking a good place to eat. Like nobody wants to have a mediocre meal in New York. And then like at that point, there's been like 3 or 4 touch points where I've probably figured out like what they broadly want in their life. And if they want a venture capital fund, I'm happy to talk to them about it. And, with anyone who's a net new LP at this point, I probably have already gotten my fund subscribed where I can make an ask saying like the fund's already raised, but if like you want to invest, you're welcome to. In the beginning, I probably would have pulled off the ask because if they're showing up 3 or 4 times to like spend time with me, they probably don't hate me, like they probably are willing to. And then, and then it's a conversation of, hey, let's have a conversation and talk about the fund. Because I don't want to like dupe them into thinking that we're going to have a hangout and like turn it into a sales pitch. And I'd rather spend 15 to 20 minutes with them over a Zoom. Here's what it does. If you want to talk about it more, let's go, let's get together in person. But there's nothing worse than having like, and as VCs, we've all done it, being in a pitch meeting in person where you sit down for lunch in 4 minutes, you're not going to invest in the company. You're like, fuck, I got to figure out how to spend the next 56 minutes of this conversation being transparent, but not rude, but like, this is going to blow. I don't want to put them in that position either. And, and then the diligence process is, this is how we think about investing. Here's a handful of companies we've invested in, and maybe it's a memo or 2 if they're serious about it, they're under NDA. Here's a memo of a deal we didn't do and why we didn't do it. Do you want to talk to 2 or 3 references of ours? And by then, you kind of know where the conversation's going. That would be how I'd close a high net worth individual. They're not going to do ODD. They're not going to have a consultant. They don't get more than 2 reference calls because I got to be careful with my references. But that'd be generally how I close a high net worth. And on average, the LP that we have, I've known for 18 to 24 months before they commit.
Curious, as you built this up, how you employed, because like historically, like small funds, earlier funds have had some of the highest returns. It's tougher to scale. It's tougher to maintain ownership position, and so people will employ SPVs and other different types of vehicles over time. I'm curious how one-off opportunities have played a role, either because you thought there was a particular opportunity, or, and I don't know if you do this, because you met somebody that had money to put to work that you thought you could put to work well, even though you didn't have a deal. Like, have you ever met somebody who said, hey, you're smart, you should go look at this space if you wanted to do something on a one-off? How did you manage like sort of one-offs versus funds and SPVs as you built this up over time?
So in the beginning, well, one, you only get one track record in life. And so if someone's willing to give you money for an idea that you don't think is a good idea, like you don't get to walk away from. I mean, there's people, I was about to name a couple of people. There's people that we all know who have somehow figured out how to be a cat and have 9 lives. But broadly, you don't. You only get one track record. So I think it's really dangerous to take money for an idea that you don't think is a good idea. The flip side, though, is I don't think that you need to be like I think a lot of people fail because they want to raise a discretionary fund and they're only willing to do it if it looks a certain way. And in the beginning, I was willing to do anything I had to do to get up and running and be in business. In the beginning, I raised this like tiny little fund and I didn't really have to pay myself, but I looked at my K1 from like 2015. For sure, I think I paid myself $41,000, and I lived in like an apartment with way too many roommates, and I had like 30 something dollars I could spend per day. And it's a really depressing thing to tell people that you're trying to be an investor and have $30 you can spend each day. And the worst thing in the world would be like I'd go try to pitch an LP and they'd want to go to like a dinner that cost $100, and I was like toast. So yeah, I was willing to raise 1-by-1 SPVs, but I figured that the investment was good and that it wasn't just one deal, that I could use that deal to do another deal and another deal and another deal. And I didn't have an ego where I had to like raise a fund. I was willing to raise single name SPVs at a time, but I knew it had to lead to a business. It couldn't just be a trade. where that thing wouldn't help with the next thing and the next thing and the next thing. And, so in the beginning, it was do what you got to do, as long as it was putting you on the path to the end goal and not being like too particular exactly what the end goal is. So like I have like a 1-year-old and my wife and I are trying to figure out how to have raise kids in New York. And my insight has been so far that like if your dream is to only have your kid go to one particular school, there's like a high chance you're gonna be disappointed. But if all you care about is your kid going to a good school and you're like not exactly particular about it, like you're probably gonna be okay. I'd say there's like an analogy somewhere in there about investing. Like you don't have to have like the exact perfect fund that you wanted, but like close enough. It's in the right direction and it's bringing you closer to where you ultimately want to go. And so in the beginning, that was the approach. And the framework is generally as follows, which is the faster you want to grow your business, the more willing you are to have lots of complexity and raise a bunch of single name SPVs or raise funds for a very specific thesis, because those are easier to raise for. But you're going to give up autonomy and probably being as good of an investor as you could be with more flexibility. And if you want to raise as slow as possible or grow as slow as possible, and you want to have a fully discretionary fund that lets you do anything you want, but you're going to grow more slowly. There's a hiring version of that, which is if you want to grow really fast, you make a bunch of senior lateral hires where you can raise around their resumes, but you're going to have like this like crappy quilt of like a bunch of different cultures and personalities that have a hard time working together, but at least you grew really quickly. And the best way to grow an investment firm is to hire young and grow talent organically. But you can't raise money around the resumes. They don't know as much. They can't join boards as quickly, et cetera. And so you have to grow them. I think you just have to figure out where on that spectrum you are. The other advantage I had is I was 23. Even now, we were at an offsite, at 2.5 billion of AUM, I plan on working until at least I'm 65. So if we grow 20% a year for the next 33 years, we'll be 400 billion of AUM. And we earn about 12 net on our credit business each year. So I only have to add 8% net new capital. My age and how long of my horizon is allows me to be patient and disciplined about not being overly opportunistic. And it's the same as with a software company. If you can land McDonald's, you may be willing to do a bunch of customized stuff to your software to go do it, as long as McDonald's is pulling you generally in the direction that your product should go. And you're willing even to go a little bit deviant of it to land that big contract. But you can't like build something that you don't believe in that won't scale.
So first of all,
sorry, go ahead.
Yeah, no, I'm going the same place you are. First of all, congratulations on the 1-year-old. I did not know that. And now I know what our breakfast conversation is going to be about. We'll do the whole kids in New York thing. But I want to leave enough time for questions. But I just want to ask like one quick one of, oh no, sorry, Hallie, you had a question that you wanted to ask.
Yeah, so just, some of what you talked about in that last piece is like how structuring your investments can actually kind of like be part of the strategy itself. And so obviously hot topic of the past year or so is how the macro environment is affecting fundraising and making it more of a challenge. Can you talk about how, in your eyes, structuring can continue to be kind of like a strategic choice for managers in a more challenging macroeconomic environment?
So, and when you say structure, and you mean like when you're making an investment, you want to put like participating preferred securities or liquidation preferences or seniority in the security or something like that?
Yeah, any piece of it, or talking about, the use of different types of investment vehicles. You talked about the SPVs, funds, et cetera.
Yeah, I mean, the harder the market is and the less track record you have, the more you should raise SPVs deal by deal because it's easier to raise money. And the hotter the market is and the more track record you have, the more you should raise discretionary funds. And you got to figure out where you are in those goalposts. And there's no right answer. It's just you go to the market, you see what you can raise for, and the market will tell you. In terms of investment strategy into portfolio companies, when the market is really hot and rates are really low, you want to be a net seller. So if you are in venture capital, you want to be as early stage as possible and not take your pro rata as much. So you can be like a net seller into growth markets. And if you're in credit, you want to be the bottom of the capital structure and sell like shitty senior paper to banks who are willing to buy it at 3 to 4%. So because you have free money. And like, that's why everyone should have bought a home when like mortgages were cheap, because like you're a net seller to the banks who are buying your shitty senior paper and you're like the equity. So you want to go to the bottom of the capital structure. And when rates are high and the market sucks and you're about to go through a bear market, you want to go to the top of the capital structure because you get paid for it in the form of high rates. And also because like you want to be the net owner when everything falls apart and you want to be in the bottom of the capital structure. And when you have no fucking clue what's going on, like in the market now, in my opinion, because like this is just so confusing, nothing makes sense. You want to be in short duration assets because the longer duration the asset, the more interest rates will fluctuate the value of a thing. You also want to be in short duration assets because by the time the world becomes more obvious, you'll have gotten your money back in time to go deploy in that market. And you also want to be in businesses where the valuation doesn't matter as much, either because you have made an investment where the return is contractually obligated, say through a preferred return, or counterintuitively, you want to be in a company that's growing so fast that even if you screw up the valuation, it won't matter because the valuation will catch up. So like if you invest in a 30 to 40% grower and you get the valuation wrong, it won't grow into that valuation. But if you invest in like 100 to 200% grower and you think that could happen for some big TAM, if it's 100% grower in a small TAM, this doesn't work. Then like even if you get the valuation wrong, you're still able to overpay and get paid for it over the duration of your fund. And so when it's a market where you have no idea, you want to be in short duration assets that are usually self-liquidating if possible, so they're profitable, they can pay themselves off, and where you're doing deals that, where the valuation doesn't matter, either in the form of structure or investing in something with such turbo growth that the valuation you pick won't matter in the end anyway.
I want to give enough opportunity for some Q&A so we can get some attendee hands raised. I know a couple went up during the session, but happy to bring a few people up until I see those. Oh, here we are. Cool.
Yeah, I see a couple of questions in the Q&A. I'm happy to kind of go through them. But
yeah, sure.
How did you manage the administrative costs of raising multiple SPVs? It's a lot. We actually raised equity capital into our management company. We raised $4 million, which I didn't mention. That's important. And by the way, that was one of the ways that we got our first believers of people who were more willing to make intros. And those SPV costs were brutal because, $15,000, $20,000 per SPV, like that's a lot of money. And so you have to be able to raise a couple $1 million. And in venture capital, it's very challenging because you can't, if you raise a $5 million SPV, you can pass that $20,000 cost to your investors, and that would be like an allowable expense. Usually the things that you can pass to your investors are things like legal expense, audit, admin, and formation. By the way, if you're like a VC exempt reporting advisor, you don't need to get an audit and an admin every year, which ends up being $15,000 to $20,000. If you're an SEC registered business, you do. Luckily, in venture capital, you can broadly be an exempt reporting advisor, but you have to be careful about not letting your investors get too much liquidity in the SPV. If they start buying, trading, and selling in and out of the SPV, you might lose your status. But that would be the main ways: raise a big enough SPV, and then you can, usually your investors will tolerate 1% to 2% allowable expenses.
And actually, just a quick question about that, because I was actually recently talking to Kat from Middleton from the Venture Collective, and she was talking about how she had raised into her management company a little bit. Did your early backers, did they know about your vision of building an investment management company versus just raising each of those funds or vehicles at a time? Or is that something that they were sort of more on board for because they had built these bigger investment management funds and it just made it more interesting for them to see like, oh, you're trying to do this too? Or did that not come until later?
No, I think I always was clear. I think it was hard to talk to me and not get this like energy of feeling like, he probably wants to build like a firm. So then it's like the question behind the question might be like, how do you deal with LPs who like their number one goal in the world is that you stay as small as possible so that your returns are super epic, while like you end up being ambitious enough where like you're actually a good investor in the first place. And it turns out that like ambitious people are often better investors like than unambitious people. That's like not like too controversial. And ambitious people like want to grow in their careers. And so if I hire a bunch of unambitious people, my firm's going to suck. And if I hire ambitious people, I have to like either allow them to grow the scope of their role because the firm has grown, or because I like allow them to be super political and like take scope from senior people, which is like pretty crummy and scuzzy. So like that's not so good. Or like the senior people have to like voluntarily leave and like leave like the next generation with like all the economics, which does happen. But I'm 32, so I'm probably not going to leave anytime soon. So I think that the answer, the same as politics or global anything or anything controversial, is it's not one or the other. It's just you have to have like a rational, nuanced approach. My view is that the firm should grow at the pace that our employees earn the right to grow at. So Charlie, Saqib. I think Saqib is a hardworking, ambitious guy. And as he grows his career and he wants more scope, I need to make sure there's capital available at the pace in which he can continue to invest. Not faster. I shouldn't put him in an uncomfortable position. He shouldn't be doing pre-IPO investing tomorrow, but like I should give him the scope and ability to continue growing in his career. Otherwise he'll leave. And the strategy, you have to like have a strategy that scales. And so one of the things that we've done is by having multiple strategies, it helps us in two ways. The first is we can tell relative value in the economy Where like if venture is like too much of a bubble, I can do more in asset-backed credit. Like when I was talking about where in the capital structure you should be, depending on where we are in the market, I can lean to the relative value by being in multiple places. And when part of the market is cold, I don't feel forced to invest. If you're only in one asset class, it's very boring not to do a deal for 2 years. Like that's really scary and it's like demotivating to your team. But if I can always allocate resources to wherever the best relative value is, that's good. It also lets me be mega ADD and curious about the world while not taking my seed fund and making it like a $7,000 million fund. Like I can grow the firm without screwing up a strategy.
Gotcha. Let's see. How many one-offs did you do over time?
So the one-offs, it really depends on, I've probably done like a couple dozen. And ultimately what you're trying to demonstrate is like some mechanism of being successful. And so like the tighter your one-offs are to each other, where they're following the same thesis, you probably don't need as many of them. The quicker the feedback loops of those one-offs, you probably don't need as many of them. And the wider they are apart, the more you need of them. I don't think that there was a magic number. I will say, though, that trying to get your investors to do more than one is a good thing. Like our SPV track record is pretty good, in our opinion. But we have definitely have certain people who have only invested in one SPV, and that SPV has sucked. And like they think I'm a moron. That is like such a crappy experience because all I wish they did is just invest in all my SPVs. So they would like, they're like not mean to me, but they definitely think I'm stupid. And then we have other people who've invested in one SPV and it's ripped and they think we're way better than we are. Ultimately, the way though to raise money for a fund is somebody ends up being in one or two of your SPVs. They make money. They have a good experience. I'd like to think that it's super sober and rational how they make the decision. I think if you make someone money, they'll give you more.
Yeah, that's pretty straightforward. And you said about the short duration and the feedback loops, I think is important too, especially for anybody who is going out for a pre-seed fund, or it just takes a very long time to pay people back or to see real traction among the companies. And so that's something that people need to keep in mind as they're raising too. If you're betting all of these connections and LP connections on something that no one's really going to know if you're any good for 4, 5, 6+ years, let alone whether they actually start getting money back, I think that's a hard bet to raise and scale around.
And part of it is also finding ways to shorten the feedback loops. Like I think the dangerous trap is that your feedback loop is like, oh, Bessemer did the Series A, so it must be a good company. Because then what you end up doing is you look for fundable companies, not good companies. And like if you want to be in good companies and hope like in venture capital, you can either be in the business of sourcing deals for Series A companies, or you can be in the business of finding good companies that other people don't realize are good, and then helping the company position themselves where the rest of the world realizes that the contrarian idea should actually be consensus. And then like your profit margin is turning an unobvious idea into an obvious one and then helping it raise money. Because if you're looking for a company that already looks packaged and fundable, there's like a less of a step up. You're taking more valuation risk and there's less profit margin. And so, so we work really hard not to judge our success based on the brand names of the firms that come after us. Although, of course, that's a good thing. Instead, what we do is in our memos, we're very clear of like, here's the things that we need to believe about a company. And what are the things that this company would need to prove? And how would we judge if they're proving it? And like, that is success. And then we spend a lot of time with communication, whether it's webinars, letters, one-on-one communication with investors, constantly making sure they know, just like a startup would with their venture capitalists, of like, this is what you should be able to tell is it's working or not working. And just like you would never tell a startup that the only metric they should pay attention to is revenue growth, that there's like all these de-risking things and product innovations and stuff they want to prove, you have to train your LPs on how to judge you as well. And that's one of the ways to, as a pre-seed manager especially, demonstrate shorter feedback loops but yeah, you have to be willing to endure a long winter. If you have an expensive life, you probably shouldn't become a VC. Like, you should go get a big job at a hedge fund or something.
For sure. I want to be conscious of time and I'm going to let you go. But just before we do, best new restaurant that you've eaten in over the last year in New York?
I'm trying not to be cliche though.
It's fine. You can do that.
Teresi's crazy. Teresi's so good.
Okay, that's the first one that came to mind. We're going to go with that.
I'm sorry. I know it's like,
no.
I went with Major Food Group. I mean, they're amazing. I don't know how they do so many good restaurants, but I could be better. I'm in the business of taking contrarian ideas and making them obvious. I just went with Major Food Group. Fuck me.
It's okay. We're going to forgive you on that. Thank you so much for your time. Really, really appreciate it. I just want to let everybody know that Haley just posted a link in the chat about Sidecar. And just before we go, Haley, do you just want to mention more about Sidecar and what they're going to find in that link?
Sure, I'll be brief because I know we're over time. I dropped a link. It's inspired by Ollie's mention of the cost of SPVs, which are not exactly, in many cases, are not quite what they maybe once were. So if you're interested in kind of cost-effective SPV or fund administration solutions, please do get in touch. Sidecar SPV pricing starts well below that $10,000 or $20,000 mark. And we'd be happy to chat with anyone who's interested.
Cool. Thanks a lot. And we'll do that dad breakfast soon.
Yes, don't threaten something you won't actually keep.
Dude, I really want to do that.
You have over a decade of emails to prove that I will follow up with you.
I'm well aware. All right. I'm going to go track down your high school friend and make sure she gets tagged on LinkedIn.
Perfect. I'll see you guys.
Okay. Talk to you later.
Bye.
Bye.